Same with rock. That's going to probably be a typical physical flow. But the other benefit is that rock isn't going to spoil because it's sitting down there. Mulch could, but they just want to be careful that they at least don't keep adding to the pile so they can get rid of the mulch before it molds or decomposes. So let's go back to our example of our Houston Astros, where we've got these various purchases. The ending inventory we know is 450 units. If it's last in, first out, that means for purchasing or selling purposes, the last items are the first to be sold. But for inventory purposes, we're going to come up with the oldest items. So for 450 units, we're going to take this 100 units at $10 a unit. We're going to take this 200 units at $11 a unit. So that's at 300. Then we need to take 150 of the August 24th purchases at $12 a unit. So do you see here? Our ending inventory here is 5,000. In the previous example, the ending inventory was 5,800, wasn't it? And our cost of goods sold is 7,000. In the other example, the cost of goods sold, what was it?
6,200.
6,200. So the difference is a matter of which specific items are we showing for cost of goods sold versus ending inventory. So when we're dealing with last in, first out, it's basically those oldest items stay in the warehouse for cost purposes, and the newest items are the ones we sell. Then we've got something called average cost. This basically takes all the goods available for sale, comes up with an average, weighted average. So if we had a purchase of 100 units at $11, we're going to weight that 100 units at 11. If we have 500 units at 12, we're going to weight that and take a weighted average of all these goods and come up with an average price per good.
This kind of be like stocks?
Yes.
What people do for that?
Exactly.
Just it doesn't matter what your average is, that's all.
You keep track of it. It becomes a little more difficult because this average is always going to change over time. So in this scenario, the way we take a weighted average is we show we added up all of our costs, 12,000, we added up our units, and we take the units divided by, the total amount of cost divided by the unit gives us our total cost. So 450 units at an average of $12 a unit is going to equal our total cost here. And then our cost of goods sold is going to be the difference. So you can see from each of these methods, we ended up with different ending inventory amounts and different cost of goods sold because we're applying it in a different fashion. So as you see here, this little analogy, we have all these purchased goods and we take and come up with an average. And as you see, our warehouse, we're using that average cost. And then the goods that we have sold, we're using that same average cost to just spread it all out equally. So how does this affect our financial statements? As you see here, FIFO, typically speaking, costs are cheaper. The product costs are going to be cheaper earlier in the year than they are going to be later in the year, assuming inflation. So if we use FIFO, then that means we'll probably have higher net income. Because if we take into account those first products or the first ones sold, we're using the cheaper costs to show into cost of goods sold. If we use LIFO, the exact opposite is true. If we're saying and assuming that goods normally increase in price, they don't decrease usually. If the last one that's in is the first one we're gonna sell, then that means our cost of goods sold will probably be higher under that method than under FIFO. Our inventory is gonna be lower than FIFO, but our cost of goods sold will be higher, which reduces our net income. Make sense? Then we've got something called average cost, where it's typically, as you can see, in the middle. Now that isn't always the case, just varied on when things are purchased, okay? And what the costs are. But generally speaking, the average cost typically is going to be somewhat in the middle of FIFO and LIFO. So the cost flow method that often parallels the actual physical flow of merchandise is A, FIFO, B, LIFO, C, average cost, or D, gross profit method. A, woo-hoo! I'm gonna start yelling like him.
I'm sure they'll be confused.
Okay, so what I want to do is take a moment and let's work through a problem.
We're a whole bunch of nerds in the morning. That abuses us.
I laughed at you when he did Nunez.
Okay, let's look at,
You have nightmares about Nunez?
Just I googled like what is the equation to find like this and that, and I couldn't find anything.
let's look at these brief exercises. Well, let's look at, let's start with BE chapter 6.1 on page 314. Tiffy Company identifies the following items for possible inclusion in the physical inventory. Indicate whether each item should be included or excluded from the inventory taking. A, 900 units of inventory shipped on consignment by Tiffy to another company.
Yes.
Yes, because Tiffy is the one owning them, putting them on consignment somewhere else.
Oh, we put them on consignment. Okay. To our stuff.
3,000 units of inventory in transit from a supplier shipped FOB destination. Nope. We are not going to pass title. Title will not pass till we receive those goods with FOB destination. C, 1,200 units of inventory sold, but being held for customer pickup. We shouldn't, if we show it as a sale, we shouldn't include it in our inventory. Letter D, 500 units of inventory held on consignment from another company. No. Okay, so let's look at E61. Let's look at these. Columbia Bank and Trust is considering giving Gallup Company a loan. Before doing so, it decides that further discussion with Gallup's accountant may be desirable. One area of particular concern is the inventory account, which has a year-end balance of $275,000. Discussions with the accountant reveal the following. So I'm going to get in here and just start a worksheet, okay?
I think that might be a response to include.
Please. So our inventory balance shows $275,000. Okay? So let's look at each of these scenarios to decide if they should be included or not, or if they're not included. Gallup sold goods costing $55,000 to Basil Company, FOB shipping point, on December 28th. The goods are not expected to reach Basil until January 12th. The goods were not included in the physical inventory because they were not in the warehouse. Is that right, though?
Yeah.
It's correct.
Yep.
Gallup sold them free on board shipping point. So when FedEx came to the warehouse to pick them up, the title has been transferred,
Oh.
okay?
I thought it was their ownership because they sold it. That's why I said no.
Gallup sold the goods to Basil Company, but the arrangement is FOB shipping point. So basically, if Gallup sold those goods to Basil FOB destination, then they would still own those goods until they hit Basil Company. But because Gallup sold them FOB shipping point, that means from when Gallup put them on the truck, they no longer own those goods. They've sold them. The transfer has taken place. Does that make sense?
Are we gonna talk about revenue in a later chapter?
What's revenue?
Well, like as an example, they're shipping out these goods. They're not in inventory.
I was being a smart aleck.
Okay. But they're shipping out these goods, they're not in inventory. In that case where you mentioned that they went from 41% to 78%, when are they do they record the revenue similar to the way that they record the inventory so that it matches?
They have to, correct. There are certain recognition guidelines in recording revenue.
Okay.
So
Based on the shipping.
Absolutely.
So like if it was destination, they might not record it until later, or if it's shipping point, they'd record it now.
Absolutely.
Okay.
Otherwise, you're not matching your revenues with your expenses. Absolutely. Okay, so let's go, so we know number one is correct. They did it right. Number two, the physical count of the inventory did not include goods costing $95,000 that were shipped to Gallup FOB destination on December 27th and were still in transit at year end.
Uh-oh. Correct.
It's perfect because Gallup purchased goods. The goods showed Gallup would transfer title when they hit the shipping dock. They still haven't hit it, so that's correct. Number three, Gallup received goods costing $25,000 on January 2nd. The goods were shipped FOB shipping point on December 26th by Lynch Company. The goods were not included in the physical count.
They should.
They should be included, shouldn't they? So we need to add 25,000 to this figure. Then we've got Gallup sold goods costing $51,000 to Lamy of Canada, FOB destination, on December 30th. The goods were received in Canada on January 8th. They were not included in Gallup's physical inventory.
They should be.
What's the inventory here we're talking about?
Yeah, it's just.
December 30th,
They sold them on December 30th.
they sold them, so we're talking year end, a year end balance.
Yep, so it should be included.
That should be included of 51,000.
Oh, yeah, I'm getting this.
So they didn't get there till the 8th. It's
So-
just been transferred.
So we're not gonna
Yeah,
show them.
so-
Still
yeah.
ownership of the title on the 31st.
Yep.
Next, we show Gallup received goods costing $42,000 on January 2nd
Okay.
that were shipped FOB destination on December 29th. The shipment was a rush order that was supposed to arrive December 31st. The purchase was included in the ending inventory.
Should be.
Shouldn't be. Minus 42,000.
Oh, so it was
Not really
supposed to be there 31st, but it didn't get there till January 2nd.
Right, it doesn't matter if you ordered it rush or not, it's
When
not
it
theirs
actually
yet.
gets there.
Exactly, it's not theirs
40,
yet.
was that 42?
I think so.